Good afternoon or good morning, everyone, wherever you are in this world. Welcome to our Equity Academy. My name is Johanna Garland. I'm the Policy Director at Gogla, and I have the honor to introduce this academy to you today. So we wanted to do an academy on equity, as we found that many of our younger members were particularly struggling around attracting early stage equity and entering their first prize rounds. We also saw from our recent deal database that equity has become short in supply in this space. So we wanted to zoom into valuation questions that attract a lot of discussion these days, but are not very transparent, and also into some tools like convertible notes on a more technical level, allowing our members and other interested companies to learn more about these tools. To do so, we have worked with the Catalyst team based out of San Francisco. Dan is joining us from a really early morning start here. Thanks, Dan, for that. Dan and his team have been looking into equity practices in the off-grid solar space, trying to find out what is common practices, what's happening right now, and then helping us to shed some light on what we can all learn from that and how companies that are now going into attracting equity can position themselves. So this academy is part of a broader suite of academies, which you can all find on our website. If you visit www.gogla.org and then go on to the Access to Finance Hub, you'll find plenty of resources around access to finance, and you will also find all of our other academies that circle around the topic accessing finance. I should let you know that this webinar is being recorded and will also be available on our YouTube channel in a few days from now, I guess. Please do ask your questions throughout the webinar using the questions pane on your control panel. We'll have several moments throughout the webinar where we can take and answer questions, so please do not hesitate putting your questions there whenever they pop up. Before handing over to Dan, I should be thanking GIZ, who've contributed financially to this academy and helped us to make this happen. So without further ado, I'd like to invite Dan to introduce himself and start the presentation.
Great, thanks very much, Johanna, and good morning and good afternoon to everyone that's joined today's webinar. As Johanna mentioned, my name is Dan Murphy, and I am the Director of Catalyst Off-Grid Advisors. Catalyst is a boutique advisory firm that focuses exclusively on the energy access challenge in emerging markets throughout the world. And we do a lot of work with investors, philanthropics, with enterprises and entrepreneurs, and with and bilateral and multilateral organizations as part of our work. And we've had the great pleasure of partnering with Gogla on this assignment, and we're really looking forward to walking you through the content that we've developed. So what I'd like to do, apologies, I'm just here we go. So in terms of our session agenda, we do have a lot of ground to cover, and as Johanna alluded to, we want to try and make this as interactive as possible. So please, as you do have questions, please feel free to pose those to us, and we'll pause at the end of each of these sections that you're seeing here to respond to some of those questions. So our the first part will cover introductions and context. The second will cover our first chapter around equity and equity-like investments, particularly focused around convertible notes, and then we'll shift the focus to equity valuations and valuation practices in part 2B. And then we'll wrap up by talking about intangibles, and we'll have a closing Q&A session with the remaining time that we have. So to get things started, I'd like to first of all set the scene a little bit and give you a bit of context. So again, as Johanna mentioned, we were asked to focus on particularly on early stage equity financing into the off-grid solar space, and in particular around seed stage and Series A financing, with an emphasis on sort of the methodologies and tools that are used to arrive at valuations associated with those fundraisings. And more broadly, we wanted to make sure that the webinar participants also had a better understanding of the formal investment process itself, not just in terms of the steps that you go through, but also some of the intangibles that investors and entrepreneurs should be looking for in one another. And of course, we want to make this as interactive as possible, as I mentioned. So we had a team of 4 individuals that worked on this assignment. In addition to myself, we had my colleagues Ian Muir, Christine Eibsinger, and Tao Nguyen that developed this content. And what we did was sort of three different facets to the work. First, we do have a great deal of experience ourselves as entrepreneurs, as investors. In fact, we've set up a financing platform called Venture Builder for early stage off-grid solar companies in Africa, and in that context, bring the investor lens. And of course, our core work is in an advisory capacity. So we leveraged all of that, but certainly didn't want to be presumptuous. We also did quite a bit of homework to make sure that we had our facts correct. And I think the third and most important facet is that we actually had several interviews with key players in the industry, notably some of the most prominent investors into the off-grid solar space. And also we interviewed several enterprises themselves. And in particular, we focused on this early stage financing question. And we actually did this in the context of having signed non-disclosure agreements. So all of those conversations were on background, and those findings, we'll share some of the anecdotes and findings with you, but of course those findings will be anonymized and not attributed to any specific organization or individual. So just to set the scene a little bit further, I think many of you already know that the off-grid solar business model requires a lot of time and a lot of resources in order to prove it out. And this visual is actually from an excellent report that was produced by colleagues at Acumen last year, and basically demonstrates in the top left kind of the stages of growth of an energy access enterprise, going from a blueprint stage where you have a great idea, moving into a validation stage where you're actually getting those proof points on the ground, and then getting yourself ready to scale up and actually scaling over time. And you'll see that we indicated the amount of capital that's needed just for those first 2 stages, and that's a significant amount of financing that's needed, again, just to prove out this business model. And I think it's also noteworthy that it does take quite a bit of time to develop and have those proof points that particularly institutional investors will be looking for before they are willing to consider investing in your business. So another important observation here is that, as you can see, what we've done here is we've plotted the investment flows, the announced financing into the off-grid solar sector between 2012 and 2018. All of this data is gathered and curated by colleagues at Gogla. And I think what's most striking here is that you'll see that the blend of capital has really shifted over the past 6 years. So in the early years in 2012, what we were observing was a fairly significant amount of grant capital and a fair bit of equity coming in, which really reflected the nascent nature of the industry and the fact that they needed that very risk-tolerant grant financing and early equity to get those businesses started. And as the industry has matured, we've seen that blend of capital really shift in quite a pronounced way. whereby now what we're seeing is that the majority of the capital into the industry is actually in the form of debt. And I think most strikingly, what we've observed is that the announced grant financing into the sector has really come down in an alarming way. So in 2018, that blue there, the light blue on the bottom representing grant financing, was only $3 million, which is less than 1% of the total announced financing. And I think the other encouraging trend to observe here is this line, and this is showing the total volume of capital year on year that has been announced. And there's been a really significant and consistent uptick in the financing flows into the sector, which is quite encouraging. Now moving on. This slide, the purpose of this slide is to show you first on the left some of the major institutional players that have been the real backbone in terms of financing the off-grid solar industry in its earliest days. And so a lot of these players have been around since 2010, 2012. And as you can see on the right, they've supported some of the biggest names in the off-grid solar industry. And not surprisingly, you'll also notice that there's a lot of overlap in terms of multiple financing partners that have backed the same companies. And in fact, this is actually quite pronounced in that there are about 8 to 10 businesses in the off-grid solar industry that have actually garnered about 80+% of the total financing to date in the sector. And I think what's most striking about the financing partners that are listed here is that some of them continue to be very solid backers of the off-grid solar space, but there are some that have moved on and have either deprioritized energy access or have moved off of backing the pay-as-you-go model, or have moved off of financing energy access in East Africa, or have had a pool of financing that has sunsetted. And as a consequence, that's why we're seeing the trend observed last year in the previous slide with the lower amount of capital flows into the sector, particularly in the form of grants. So I want to speak for a moment about the investment process, and we are going to focus the bulk of our conversation today around step 4, around terms and instruments, but we really felt it was very important to help contextualize that first. And so what I'd like to do is first start on the left-hand side and talk about step 1, which is what you as entrepreneurs need to do in order to get ready to go out and fundraise. And investors, whether more sophisticated institutional investors, or whether it is a high net worth individual that acts as what's referred to as an angel investor, they're all going to have certain expectations in terms of certain materials that you're going to need to put in front of them. The first of which is typically a 1 to 2 page write-up that very concisely describes your business, your idea, what's the problem that you're trying to solve, how are you going to attack that problem, what makes you unique and different, and what do you need? What are you looking for from prospective investors? The second piece is a business model or a business plan. This often takes the form of a PowerPoint presentation and can be anywhere from say 15 to 30 plus slides, and really goes into much more detail, articulating not just from a strategic and operational perspective how you intend to deliver and scale your business, but it also will talk through some of the financial assumptions and projections that you've put forth. Those detailed financial projections also need to be prepared and drafted in the form of an Excel model. These can be, quite simple and basic. A lot of times, investors will be satisfied just to see a fairly basic workup of financial projections. It can also go as far as to be a very sophisticated, complex financial model that someone on your team or someone who's advised you has built out on your behalf. The next thing that you'll need to do is think about retaining a lawyer. I think the general advice is that the earlier you can bring in a lawyer to work with you, the better. Lawyers generally are quite expensive, but bringing in a lawyer late in the process where they have to unwind certain things or fix problems that you may have inadvertently created with your investors often proves much more costly than bringing them on at the outset. And the last set of support that you may want to bring on are transaction advisors. So there are specialized firms that will work with entrepreneurs to help you prepare these materials, and will also leverage their network with investors to help facilitate introductions and get you that opportunity to convince people to part with their money on your behalf. And that actually moves us into step 2, which is what we're referring to as chasing investors. So getting to maybe getting an investor interested. And I think here, you just really have to be very, very persistent and be prepared to leverage your network and be ready for lots of no's and for people to respectfully decline the opportunity to hear more about your business. But what I've found is useful, and what we suggest to entrepreneurs is, even at the end of a conversation where there is a no, always be sure to ask if that individual has any recommendations of other potential investors with whom you should speak, and whether they would be willing to facilitate an introduction. And of course, the last point that I want to mention is, always ask for advice as a part of these conversations, and always be very, very gracious and appreciative of the potential investor's time. So moving into step 3, the due diligence process, which is when you've got an investor that has said maybe, and what they'll say then is, okay, I want to get to know you and your business better. And they'll go through a process that will look at several different facets of the business, and each investor is different in terms of the approach that they take to doing this and the level of detail and rigor that they take into this process. But generally, there are about 5 buckets into which due diligence typically falls. The first is around the commercial considerations, around your product, your competitors, your customers. The second is around operational considerations, team, which is critically important, particularly at an early stage, to demonstrate that you have a solid team that both understands your customers and understands the business that you're trying to build. Other operational considerations around supply chain, even environmental and social safeguard considerations. Financial considerations, wanting to understand profit and loss, both actuals and projections, how you're going to manage your cash flow, how you're going to manage more broadly the finances of the business. Then there's all the legal and governance considerations, making sure that you are legally registered and in good standing in the country where you operate, that you actually have a board of directors that is functional and meeting, and that you may meet certain integrity due diligence checks to make sure that you don't have any blemishes on your record at a personal level. And then I think the last piece is, and arguably the most important, is around strategic fit. So is there good chemistry between the investor and the entrepreneur? Are the circumstances right in terms of where the entrepreneur is today and what they need vis-a-vis what the investor brings to the table themselves? And then in terms of negotiating terms, and which is where we're going to get into detail here in a minute, here really there's several different terms that are quite important, and we'll discuss those in a moment. There are other considerations around governance and whether investors will take a seat on your board, what other rights and entitlements that investors will have as part of them putting capital into your business, and along with reporting requirements and other considerations as well. And I think what's really important here on the bottom is to understand the question of time. So just that first step of preparing your materials and getting ready to go out and fundraise, can easily take 2 to 3 months, and it really depends on how much time the entrepreneurs have to dedicate to it. But it is a pretty significant undertaking, and having done it a few times in my career, I can assure you that it takes a lot more time than one would like or expect. And having also been on the other side and doing the fundraising as well, I can also assure you that too takes a lot of time, and that's why we actually put this quotation in the bottom right, mentioning that fundraising is quite often a full-time job, particularly for senior leadership of a given business. So let me pause there, and let's move on to any questions that you may have, and I'll ask Johanna to intervene now and curate that discussion.
Great. Thanks so much, Dan, for this first part of the presentation. I know it's a lot of content to already digest and take in. We haven't received any questions in the questions pane yet. So everyone attending, if you have a question, please do put it into the question section of your control panel, and then we can take it up. Alternatively, you can also use the chat function. As we're not receiving questions right now, I can see that we have a couple of raised hands. So what I will do instead, I will unmute the people that have raised their hands and ask you to share your question live with the audience. I'm starting with Teresa. Teresa, you're now unmuted.
Hello, hi.
We can hear you, Teresa.
Hello?
Yes, we can hear you very well.
Thank you for the presentation, Dan. I just wanted to ask one question. How significant is a board of directors when it comes to making consideration for an investor to invest in your business? That's it. That's the question.
Thank you, Teresa. We'll put you on mute again. Dan, you care to answer this question?
Sure, I'd be happy to do so. And Teresa, thanks very much for your question. I think the board of directors question, I think, is a two-sided one. The first is for the entrepreneurs themselves and for the enterprise themselves. And I think that it is really useful and important to set up a board, or it may even be at the earliest stages of the business that you don't necessarily have a formal board of directors, but that you have some sort of advisory group that you can work with, that you can use as a sounding board to help give you guidance as you're making really important decisions around how to raise capital and from whom to raise capital. So I think that's the first side of the answer. The second side of the answer is from the investor perspective. And I think that investors, particularly, at a very early stage, for example, if you have a nice idea for a business and you've identified a co-founder and you've identified, a market opportunity, but you haven't actually started executing on that idea, and you're looking to raise that first money in for you to get started. I think investors will fully understand if you don't have an advisory committee or a board of directors set up yet. So I think where that changes is once you actually have activities on the ground and you've taken in capital either from friends and family or grant capital from philanthropics, and you have some track record on the ground. I do think that investors will expect that you have a more formalized governance structure in place. And if you're 2 years into operating a business and you, for example, don't even have a board, or if you have a board but it's never met, that actually is a bit of a red flag for investors. And what will likely happen is that investor, as part of the conditions of their investment, will probably require you and will hopefully support you to actually improve or set up and improve that governance function, which is really important. and certainly a prerequisite for you to be able to scale and bring in capital from larger institutional investors.
Thanks very much, Dan. We have received another question using the question function of the webinar. Dan, do you have any recommendations to decrease the amount of time spent by the C-level management on fundraising, apart from hiring a transaction advisor?
Wow. Luck is part of it, and I think it also is quite often a function of one's network, your social network, and the extent to which you can pick up the phone and have the good fortune of making a few calls to individuals who know and trust you already and who happen to be investors themselves. Otherwise, I think as a general rule of thumb, I think you need to set your expectations that it is going to be a very time and transaction intensive process.
Yeah, and I think that's certainly also something that we see at Gogla is it takes almost full-time person to go fundraising. So that's something you should be very aware of in your resource planning, that you will have one person of your C level entirely absorbed by fundraising once you're going after your press rounds. I would like to encourage everyone who has additional questions to put them into the question function of the webinar. We'll continue to take questions throughout the webinar, but for now, I suggest we continue with the content and ask Dan to get us into the next section of this webinar.
Great, thanks, Johanna. So now we're going to move on to the real meat of the presentation here around equity and equity-like financing instruments. And so what I'd like to do to begin is to revisit this question around what sort of proof points and what sort of capital are you going to be looking to achieve and secure as an early stage off-grid solar enterprise. And the way that we've characterized this is into two generalized buckets, one around a pilot stage and the second around a validation stage. And basically at a pilot stage, what you're looking to do here is really just to get those initial proof points in the market. So you don't need to have a ton of customers acquired to be able to do that. I think what's more important is that you've actually identified some really critical pieces of the business model that you've stress tested. And I think one of the most important is around the product and what type of product you're going to be putting into the market, and how does that match the needs and aspirations of your customers. And I think also very importantly, how does it match the ability of your customers to pay for that product. So that also plays into another important proof point, which is around price discovery and going into the market and seeing what sort of pricing is appropriate. And when you're delivering around a pay-as-you-go business model where your customers are repaying you in monthly installments, there are several different variables that you can play around with and adjust and test, including the amount of the deposit that you require, including the monthly price or the daily price that customers are required to pay, and including the tenure, the duration. How many days, weeks, or months are you giving them to actually pay you back? The longer you stretch that tenor, the lower, in principle, the lower the price should be to the customer on a per day, per week, or per month basis. But of course, the longer you stretch that tenor, that also means that you carry more risk in terms of the financing risk of the customer and also the technical risk, should there be any warranty issues with the product that you've sold to them. So, this pilot stage, even though you'll have a number of customers in the low hundreds, quite resource intensive, as you see. I mean, that could range anywhere from a couple hundred $100,000 to $500,000. The variation really depends on the size of system that you're selling, where you're selling, how much staff you're actually recruiting to deliver on that pilot. And then when we move into the validation stage, this is where we start to get into the 1,000 plus number of customers. And here what you're really doing is taking those confirmations from the pilot stage and showing that you can start to do that with a little bit of scale. So instead of selling, dozens of systems, can you take the lessons that you've learned and actually sell hundreds of systems into a given area? And are you setting up the systems and processes and capabilities to really be able to start to deliver that product and service in that given market at scale? And again, that can be massively resource intensive, not just from a human resource perspective, but also from a financing perspective as well. So what I'd like to do now is move into the next slide. Here we go. So in terms of the very earliest sources of capital that we would encourage entrepreneurs to look for, it's actually falls into 4 different buckets that you see here. The first on the bottom are the founder contributions from yourselves. So founders sometimes will actually put their own cash directly into the business. And that's something that investors actually really like to see, because it shows that you literally have skin in the game. And that can be quite meaningful and compelling. Another way for you to invest into the business is through what's called sweat equity. So this is where, let's say, you decide that you want to start a new business, and you basically resign from a well-paying job, and you're not taking any salary in your new business. You can actually calculate the value of your opportunity cost. And again, I think investors will often really appreciate the fact that you are taking that big risk, and that there should be some value assigned to that sweat equity that you're contributing into the business. Moving up to the top, in the top left, grants are frankly the best form of capital, because they are free, and grants function typically just like equity, in that you can use those resources to finance what would otherwise need to be financed with equity capital from outside investors. And I think that the challenge with grants is that, first of all, as we've alluded to earlier, they're becoming increasingly scarce in the off-grid solar space, and hopefully that trend will reverse itself somehow. The other thing is that because it's so scarce, they're very competitive, and quite often, grant opportunities are quite transaction intensive, requiring a lot of applications and follow-up and vetting, and so you just need to prepare yourself for typically a fairly lengthy process that will have limited success. But I think the key is to throw your hat in the ring whenever you can, and through that process of applying for grants, you'll get better at it, and eventually, hopefully, you'll persevere and actually win some grant financing. The last source of capital in the top right here is friends and family. So as I mentioned earlier, this idea of picking up the phone and reaching out to those who are closest to you and getting them to put cash into the business. Again, from an investor perspective, that will be pretty compelling, because no one wants to waste or lose money that they've gotten from friends and family. So just to share a couple of statistics on the right-hand side of the slide here with respect to the interviews that we conducted earlier with as part of this process with entrepreneurs, we actually saw a wide range in terms of the cash that entrepreneurs themselves put in the business, everywhere from 0, where founders put no capital in, all the way over to up to $400,000 of their own cash that they put into the business. And then on the grant side of things on the bottom, again, in very early stage, we saw a range of no grants coming in all the way up to over $300,000 with an average of about $50,000. So I want to shift over to the discussion of the financing instruments. And what we've done here is to list out what are the most typical early stage equity and equity-like instruments that are used to finance early stage businesses. And this is sector agnostic for the moment. So you have convertible debts and equity, which is where we're going to focus our discussion. There's also convertible grants, revenue sharing and quasi-equity, venture debt and bridge loans, and a very specific instrument for those of you that are domiciled in the United Kingdom called mini bonds. And in the interest of time, I'm actually not going to walk through the instruments that are shaded in gray, but we'll focus on the top two instruments, which are the most common instruments that are used in the off-grid solar space to finance early stage businesses. And what I want to do is first focus on the convertible note. So this, based on the interviews that we conducted, both with investors and entrepreneurs, and also based on our knowledge and understanding of the market, this is the most common instrument that is deployed at a very early stage. So a convertible note is a debt instrument, and the note holder, so the investor that holds the note, will actually be entitled to have that note convert into equity at a later stage. And that later stage is when a specific event, which is referred to as qualified financing threshold, occurs. And there are several benefits of a convertible note. I think for entrepreneurs, this is a fairly standard instrument and pretty well understood and accepted by early stage investors. And so typically you can structure this in a fairly turnkey way without lots of transaction costs. And I think the second and most important point is that this instrument actually allows you to avoid having to put a valuation on your business. And this is particularly important for businesses that are still at a very early stage, even at a concept stage, when you don't really have tangible numbers or statistics around which a price can be assigned to your business. And then for investors, as I mentioned, all the benefits of this being a fairly turnkey instrument, and so it's fairly low burden for those investors, and also gives them some nice incentive and upside, which I'll describe in a minute in terms of the way in which the instrument is structured. So there's four key terms that I want to talk about with respect to convertible notes. The first is that a convertible note will have an interest rate. Because it is a debt instrument at the outset, it accrues interest. And so you will need to negotiate that percentage interest rate on the principal that will accrue on the note until it converts to equity. The second key term is the conversion discount. So this is the discount that is offered to the investor. And basically that discount, it lowers the price of the shares that they will purchase at a later date when the conversion event occurs. And just so you know, I'm going to walk you through a simulation in a minute to illustrate this more concretely. I realize this is a lot to digest and somewhat abstract, so bear with me, and hopefully we'll make it easier to understand in a moment. The third important variable, if it isn't complex enough, is the qualified financing threshold. So this is the amount of either the future capital or the total capital that you've raised into the business that will actually trigger the conversion of the convertible note into equity. So that is going to be a dollar amount that you will negotiate. And then the last key term that is not always used in convertible notes, but will sometimes be deployed, and this is particularly the case with more sophisticated investors, will be a valuation cap. And the valuation cap is basically an agreed ceiling on the valuation of the business once that conversion event happens. And if the valuation of the company exceeds that cap, then that cap is used to calculate the premium that the note holders will get when their note converts to equity. And again, I'm going to walk you through a specific example in a minute, which hopefully will help to make this a bit clearer. So just a few quick key takeaways with respect to these terms. First of all, on the interest rate, what we observe is that the interest rate is usually inversely correlated to the conversion discount. So what will happen is that investors will really typically be less concerned about aggressively negotiating an interest rate, but will be more interested in aggressively negotiating that discount. And so the reason for that is that the discount really can be a pretty meaningful premium that accrues to them upon conversion. And so what we'll see is that interest rates on convertible notes are typically anywhere between 5 and 8%. That being said, sometimes you'll see convertible notes that are zero interest. You'll see some convertible notes that will have even higher interest rates. It really comes down to the negotiation between the two parties. And on the conversion discount, again, usually what we'll observe is that the level of that discount will be correlated with the expected duration of the note holding. So if you go out and raise a note and you expect to actually convert that note in, say, 3 months, then you really need to negotiate a lower discount rate. Conversely, if you're expecting to require 18 months before that note actually converts, then your investors are actually going to be pretty aggressively negotiating for a higher discount, so that discount rate reflects the amount of time that they have to wait for the conversion to happen. And that amount of time also reflects a certain amount of risk that they're willing to take in financing your business. So that needs to be compensated appropriately through the discount rate. And then on the valuation cap, we'll get into details there, but really that comes down to a de facto negotiation of the valuation of the business in the future. And the qualified financing threshold, again, is important because you want to make sure that you set that qualified financing threshold at a reasonable level such that it can happen typically within the next 12 to 18 months. But as I mentioned, sometimes those thresholds will be much lower and will be set, for example, to convert in 6 months if that's when you expect to raise your next round of capital. So now I'd like to move on to the case study that I mentioned earlier, and after I walk through this, we will pause and take questions. So please do bear with me. So the first thing that I want to do is walk you through the discount. And so we have our business here, which is called SolarGo, and we have two co-founders, Eric and Fatima, who have this great idea for SolarGo. And on day one, you'll see that the shareholding of that business, they have equal ownership of the business, 50-50, and 1 million shares outstanding and allocated between the two of them. So what happens when SolarGo goes out and secures some early stage capital, and in this case, we've had that capital come from Boubacar Angels, which is a syndicate of, let's say, 3 or 4 individuals that are pooling their resources together as Boubacar Angels, and they've decided to put $100,000 into SolarGo using a convertible note instrument. And the 2 parties have agreed to a 20% conversion discount, and they've also agreed to a qualified financing threshold of $500,000. So Boubacar Angels moves the money over to SolarGo, and the SolarGo team is off to the races in their first year. Now, things are going well for SolarGo. In year 2, they go out to raise their next round of capital, and this time they decide to work with West Africa VC, and West Africa's VC makes a $500,000 equity investment into SolarGo, and that is a priced round, and the pre-money valuation of SolarGo is agreed to be $3 million. So what we want to illustrate here is, first of all, that the qualified financing threshold has been met. So that is what now triggers the conversion of Boubacar Angels' convertible note. And so what happens is that Boubacar Angels will now own shares in the business. And the benefit that they get is that instead of having to pay $3 a share, which is what West Africa VC is actually paying for shares, given that the business was valued at $3 million and there are 1 million outstanding shares, Boubacar Angels gets a 20% discount. So they actually pay $2.40 per share instead of $3 per share. So they get a kicker or a bonus, let's say, in terms of their shareholding in the business. And this is what the cap table, what the shareholding structure looks like after SolarGo has completed this new round of financing from West Africa VC, and after Boubacar Angels' convertible note has now transformed into equity in the business. So what I'd like to do now is move into an explanation using the same example of the valuation cap. So let's imagine that we have the same scenario with SolarGo working with Boubacar Angels, and we still have the same $100,000 convertible note. And let's, for a moment, imagine that Boubacar Angels and SolarGo agree to a $3.5 million cap on that note. And let's recall that the actual pre-money valuation that has been negotiated when the equity financing came in is at that $3 million level. And so what ends up happening is that because the valuation cap is above the actual pre-money valuation, the cap is not triggered. So what applies is the discount, the 20% discount that was part of the note. And so that is why this cap table remains the same as what we saw on the preceding slide, such that Boubacar Angels will still hold 3.4%, which reflects the 20% discount, because the cap does not apply. Now let's see what happens if the cap does apply. So here, the pre-money valuation is still at $3 million, and the valuation cap that Boubacar Angels and SolarGo had negotiated is $1.5 million. And what that means is that the cap does apply. And basically, because the cap is well, the cap value, right, of 1.5 is half of the pre-money valuation. It actually means that Boubacar Angels, instead of getting a 20% discount, actually is going to get a 2x, a doubling of their shareholding because of the cap itself. And the reason why you see here that when the discount applies, you're at 3.4%, and when you have the cap kicking in, you're at 5.4%. The difference here, and the reason why those numbers aren't, this isn't a doubling of one of the other, is that this does apply the 20% discount. This applies the 2x cap, which yields the higher shareholding for Group of Car Angels. And I think it's also important to observe that our co-founders, Fatima and Eric, are further diluted in this situation. Their shareholding has decreased slightly, as has the shareholding for our friends West Africa VC. So let me pause there. I realize that was a lot of content, and let's see if there perhaps are a few questions about this.
Thanks a lot, Dan, for this. Yes, indeed, a lot of content. Again, we have a question on the interest rates for convertible notes. My question is, can the interest actually also be rolled up?
Sorry, Johanna, could you repeat that question?
The question is whether the interest rate on convertible notes is to be required to be paid in cash, or can be rolled up and paid out in the next equity round.
Yeah, that's a very good question. And for the purpose of the example that I gave, we actually excluded the interest rate from the calculations just to keep things simple. But what typically happens is that the interest rate does accrue and gets rolled into the value of the note that converts to equity. So you don't actually have to pay out the interest in cash to anyone. What happens with that is that it actually leads to additional shareholding that your investor has, and for the entrepreneur, it's a small amount of additional dilution that occurs for you.
Thanks for that, Dan. We have another really good question, and that's asking, this convertible note seems to be a fantastic tool for companies to push back the valuation question, but are investors equally interested in this note? Is this attractive to them as well?
Yes, I do think that convertible note is, again, is quite standard and quite familiar to most investors. And in fact, a lot of times investors when they're making an investment at a very early stage in an enterprise will even prefer to use a convertible note versus trying to do a priced round with equity. And the reason for that is that, priced rounds with equity can be more complicated and complicated to navigate, and I'll explain some of the reasons why that is in the next section of our presentation.
All right, thanks for these two quick responses, Dan. We'll can continue now into the valuation section. I already received a number of questions around valuations, which we'll take up after Dan has talked a bit more about valuation practices.
Great, thanks very much, Johanna. And I will move on to our next section, which is going to focus around the second instrument, which is equity investments into a business. And for those of you who don't know, an equity investment is a situation whereby an investor provides cash into a business, and in exchange for that, they receive shares, and they own a piece of that business. And so what I first want to do is focus on the valuation practices that are typically used when equity investments are made. And there are several different methodologies that are employed, and I want to just briefly speak to all of them, and then I want to focus on what is most common in the off-grid solar space, particularly when earlier stage investments are being made. For example, when you're having what is commonly referred to as a company's first priced round, where the first valuation will be happening. So the first methodology that can be deployed is commonly referred to as the last 12 months or trailing 12 months, also known as LTM. And this is where an investor will look at your actual numbers from from the previous time period, again, typically 12 months. And this is around a key metric. It can either be revenues, it can be EBIT, which is your earnings before interest and tax, or it can be your earnings before interest, tax, depreciation, and amortization. And they'll use that plus a multiplier to derive the value of the business. So let's say that you did $500,000 of revenue in the past 12 months, then they say, okay, we feel that the appropriate multiplier here is 2 or 4 or 6, whatever that calculus comes out to is what the pre-money valuation of the business will be. The second methodology that can be employed is the next 12 months. So this is where investors will look at your forward projections, again, recalling the financial projections or financial modeling that I referenced earlier. Sometimes you'll find that investors will actually lean heavily and sometimes exclusively on those future projections to derive the valuation in the business. A third way is using discounted cash flows, which is a more complicated accounting method to look at future cash flows and discounting by the cost of the capital coming into the business. A fourth method is the venture capital method, where basically the investor will be looking at a specific terminal return on investment in terms of a multiple of their investment that they're expecting, and then they'll back up from that to derive what they think is a reasonable valuation today, and that is fair for them and for the investor today, and that will assure them of the return that they're aspiring to down the road when they actually sell their shareholding in the business. And then the last approach is to use comparables, comps, so basically to point at other cases and examples in a given industry and say, this company was valued at X or Y, and we think that we should be, valued on par or higher than that. So that's kind of an overview of some of the basic valuation practices that are employed. And again, when we look at the off-grid solar industry, what we see, and this was really validated through the interviews that we conducted both with investors and with entrepreneurs, is that there is a real significant focus on the last 12 months, and in particular on revenue, because early stage off-grid solar businesses are almost universally not profitable. EBIT and EBITDA would be negative, and so that's not an appropriate metric to use for the purpose of evaluation. However, revenues, particularly in the last 12 months, are real, and investors get a lot of comfort in focusing on that. What we heard and what we observed too is that sometimes investors will also factor in the forward-looking projections, the next 12 months, into the valuation exercise. And I think that sometimes that is done in part to give a little bit of the benefit of the doubt to a particularly early stage off-grid solar enterprise that perhaps has a lot of potential but hasn't really started to scale and acquire lots of customers, and as a consequence have fairly robust revenue. If those last 12 months revenue numbers were used, then the valuation would be quite low, and so that's where sometimes there's weight put into the next 12 months. And then I think what's really important, which is at the bottom triangle here, is around intangibles, and we'll speak a bit more about intangibles in some later slides, but this is really about you as the entrepreneur and your business, and what level of comfort does the investor have around your ability to actually execute and deliver and build value for them and deliver an impact, because a lot of the investors into this space are really motivated by the impact that off-grid solar enterprises can have on the lives of their customers. And I think the other important thing to bear in mind with respect to valuations And I think that this really influences the multiplier that is used in the calculus that investors deploy, are those bottom two considerations. The first is geography. So are you trying to raise into a fairly busy market such as Kenya, which is really the epicenter of the off-grid solar business? You know, if you're trying to do that, then investors are probably going to discount a little bit that fact because it's a crowded space. However, if you're raising into, you know, another market in, say, in West Africa where there's no competition and no one operating, that maybe will yield a higher multiplier, although maybe that's in a, you know, a difficult context in a, you know, a post-conflict country or something like that. That again will probably negatively influence the valuation because there's an increased risk profile associated with your business. And then the second consideration is around the business model. And, you know, are you pitching a cash sale business that's selling solar lanterns? Are you pitching pay-as-you-go multi-light point systems? Are you pitching pay-as-you-go, you know, very large systems that enable productive use applications? All of that will influence the valuation exercise, and in particular the multiple that is deployed. So we wanted to take a couple of minutes to talk about why valuations are both really important and can actually be really quite painful for not just entrepreneurs but also for investors. And we wanted to walk through a down round simulation. And, you know, this is really intended to underscore to all of you that, you know, getting a high valuation isn't necessarily a good thing, because when you get that high valuation, you have now set the bar for yourself extremely high. And if you don't meet that bar in terms of the valuation that has been assigned to your business, then that is going to come crashing down in the future when you go back out to raise new money from investors. So let's look at what that looks like for our friends SolarGo and for Eric and Fatima. So we're going back to the example that we talked through earlier, where Boubacar Angels has provided $100,000 on the convertible note. West Africa VC provided $500,000 in equity. And instead of that $3 million valuation that we saw in the preceding slides, we now have a new valuation of $5 million. So Eric and Fatima are really thrilled because they are less diluted. They control more of the cap table than they would have if the valuation had been $3 million. Now, the flip side of that is, yes, they have less dilution and their investors have a smaller shareholding in the business, but Eric and Fatima have now also raised the bar in terms of what they need to do and deliver with that $600,000 that they've managed to secure from those investors. And let's just say that that doesn't go terribly well, and they really struggle to execute and acquire customers, and you know, they're having difficulties with repayments, and so their revenues have just really suffered. And as a consequence, they've burned through their cash and they need to go back out and raise. And in doing so, you know, lots of investors that they talk to say, well, you know, that previous valuation was really high, and you know, we're just not really in a position to be able to support or sustain that. However, Eric and Fatima do find what we refer to as vulture VC, who agrees to come in and provide $750,000 to basically bail out SolarGo so that they can keep the lights on, literally and metaphorically, for themselves and for their customers. But they say, listen, you know, for us to put that $750,000 in, you know, we looked at your revenue for the last year and what you did with this $600,000 from your investors, and we actually think this business is only worth $2.5 million. And you know, at this point, Eric and Fatima really have no choice, and so they take the money. And in doing so, They bring in Vulture VC, who suddenly owns a big chunk of the business, as you see, nearly 25% of the business. And you also see that that has caused quite significant dilution for our co-founders, who now their shareholding is considerably lower than it was. And so this really does, I hope, underscore why valuations can hurt. And frankly, I think why, entrepreneurs really need to get good advice as you go out around and try and raise a price round, and also really try and have a very open discussion with the investors with whom you're speaking, and really look to them for guidance around that valuation. And I think it's also really important that you ask your investors, what sort of calculations are they using to derive valuation? What sort of return expectations do those investors have? That should all be part of your discussion. These are just some key insights from the interviews that we conducted around first price rounds. I think the bottom line is that in the off-grid solar space, there is no sort of generalizable trend when it comes to price rounds. It's all over the place. So as you see here, we've had priced rounds in the off-grid solar space, at least among those that we interviewed, that ranged anywhere from $150,000 of capital all the way up to $6 million. 64% of the businesses that we interviewed had actually done a price round. And in those cases, 80% of those investors took a seat on the board of directors of the company. And a couple of other interesting anecdotes. In two of the cases, the companies actually proposed the valuation to the investors and said, hey, we think we're worth this, and the investors agreed. And I think it's noteworthy that those two cases were businesses that have been around for quite a while, and they were some of the first earlier companies to raise capital in this space. And I think that really there wasn't a very good understanding, particularly among investors, as to how to value these businesses, and so those were accepted. And then another interesting anecdote that we had a couple of cases where the price rounds actually came before the convertible note. So again, just to illustrate that everybody's journey is different, and it should be, because everybody's circumstances are going to be different in terms of where the business is, and in terms of who you know and who you're talking to on the investor side, and what their expectations are. So let me pause there, and I'll pass back to Johanna so that we can hopefully answer some questions about equity and valuation related practices.
Fantastic. Thanks so much, Dan. Indeed, we do have a couple of questions. So we heard now about what are the factors that are going into the valuation. I guess a bit of the elephant in the room for many attendees is, what's the right multiplier? We haven't talked about that too much. So can you give any guidance on how to choose the right multiplier?
Yes, the audience is absolutely correct that is the critical variable in all of this. And the multiplier at the end of the day, it's more of an art than a science. So that is to say that some of those other attributes that I alluded to earlier, with respect to intangibles and with respect to kind of the underlying figures that are used to derive a calculation, are really what the investors are going to use to come up with the multiplier. And I'm deliberately kind of avoiding directly answering your question, Johanna, because it's really difficult to say that the multipliers in the off-grid solar space are this. I think we've seen a range anywhere from 2x multipliers all the way up to, in fact, there's a blog that a colleague at Acumen had written a couple of years ago, where she spoke about the fact that she had seen a proposed valuation from an enterprise that was a 36x multiplier of revenue. Not that that was accepted by the investors, but just to show that it really can range quite quite widely. And again, ultimately, I think what's important is that you have a discussion with your investors when you're talking about valuation to understand what is the calculus they're using, and if they're using last 12 months times a multiplier, ask what the multiplier is and why they've come up with that, and try and use that as an opportunity to talk around and convince them why that multiplier should change. But also, be sure to keep in mind that down round reality and the fact that you need to set yourself up for success with your valuation. Don't set yourself up for lots of struggle and hardship and difficulty and potentially failure if you are very aggressive around a valuation that you can't sustain.
Fantastic. Thanks a lot, Dan, for that. There's another question on business models. Obviously, we have a range of very different business models in the space. I guess the main two prevalent ones are PAYGO and cash sales. Would you say that valuation methodology differs for cash versus PAYGO sales or business models?
I think that in general, the methodologies will be the same. I think that the multiplier will likely change depending on the nature of the business. And, again, I think if you look at a cash sale business, generally that is lower risk than a pay-as-you-go business, just by virtue of the fact that it is cash sale. And so it could be that will influence the valuation. Likewise, on the PAYGO side of things, I think there's a lot of sort of opportunities or expectations that the revenues that you can derive from each customer that you acquire can be quite meaningful and sustained in the long term. So, it's not just that you're selling them a multi-light point solar home system and then that's it. It's the idea that you're selling them that solar home system and then you're going to perhaps sell them a cell phone or a tablet or a clean cook stove, and that those revenue streams from each customer can be more meaningful by virtue of that sticky relationship that the pay-as-you-go model creates. So it really depends on the details and can vary from business to business and from investor to investor in terms of what their perception is of the value of the business.
Great, and the factor of the valuation will also greatly depend on the intangibles and the team that the company puts forward. So let's dive maybe into the intangibles a bit more, Dan, as these are super important as we are looking into valuation of companies.
Absolutely, thanks very much, Johanna. So let's indeed do that and move into the discussion of intangibles. So first of all, what do we mean by an intangible? It's a bit of an abstract term, and so for that reason, we've actually put the definition here. And so intangibles are things that are really difficult to describe exactly or to assign a value to. So the example here is that she has that intangible quality, which you might call charisma. Charisma is somewhat of an abstract concept, but it can be actually quite important when trying to better understand an individual. And if you step into an investor's shoes, it's really important for investors to understand those intangibles around the entrepreneurs that they're considering providing capital to. But let's first move to the entrepreneurs. And here we've just taken some direct quotes. When we asked about intangibles, when we asked entrepreneurs about intangibles, this is what we heard. The first is that to really, when you're looking for investors, to try and find advocates. So, investors that are going to be with you for the long haul, and that really are going to be partners with you in building the business, and that are going to help you to both celebrate success, but also to tackle complexity and challenge and sometimes crises that will invariably emerge when you are trying to grow an early stage business. The second is around strategic partnerships and again, finding investors that can really help to shepherd you along through the fundraising process. So, typically what will happen in a financing round where there's multiple investors is that one investor will take the lead. They'll be the lead investor, and they will be your principal interlocutor for the purpose of negotiating terms, for the purpose of due diligence. And I think finding that solid lead investor who has been there and done that's led rounds before, that can clearly articulate their process and timeline is really important. Another comment that we heard from more than one entrepreneur was something to the effect of, the fact that you've got to spend a fair amount of capital to actually raise money, and it's not just time, but there are direct costs too, which we alluded to earlier. And again, I think the last one that I want to mention here is in the bottom right, sort of early preparation. So that premise of bringing in outside advisors to help you navigate the process. And I think in more than one case, we had entrepreneurs that were saying, I really wish I had brought in a lawyer earlier, because by the time I brought the lawyer in, they identified all kinds of problematic things, either on the terms of the transaction or on the legal documentation that, for example, the investors' lawyers had prepared and put forward. So that's what we heard from entrepreneurs. And I have to say that I think a lot of times what the perception of entrepreneurs is less about focusing on those intangibles of the investors that they are courting. It's more around who has money to invest. And frankly, there's such a scarcity of early stage capital for the off-grid solar space. You can't be terribly choosy. And so that being said, I do think it's really important that you make sure that there is a very strong alignment of values between yourselves and those investors that you're going to take money from. It's analogous to a marriage in a way, and in some ways an arranged marriage. And so, you really want to make sure that you get to know each other quite well before deciding to go forward. So for investors, when we asked about intangibles, quite often it was the top priority for them. So valuation and sort of the fundamentals of the business in terms of financials and business model is interesting, but it's really these intangibles that are absolutely crucial. So it really boils down to, when you're getting to know an entrepreneur and a business opportunity, are those entrepreneurs being transparent with you, sharing full documentation with you, not kind of hiding either information, or not hiding or trying to make excuses for certain things that may not have gone well, and just being honest and forthright. I mean, this all sounds very simple, but and fairly basic, but it is really important. The other is around emotional intelligence. And so, investors, and I think particularly larger institutional investors, will really read a lot into the way in which you manage the relationship with them, even when you're still discussing a possible investment. I think you need to bring your A game and put your best face forward and be very professional in the way in which you're interacting with them. So that's also a fine line. And I think another very important set of observations is around the ability of entrepreneurs to be nimble and to pivot and troubleshoot, right? So when something goes awry, that you're able to figure out solutions, and that you're mature enough and experienced enough to recognize that there are certain situations that you don't know how to deal with and that you need to ask for help around. And that can include going to your investors, even during a due diligence phase and asking for advice. I think that can actually be quite powerful for an investor if you're doing that, even during the courtship phase. And then the last point is just humility, and you know, for entrepreneurs to be humble and to recognize that you know, there's invariably a lot of tremendous value that entrepreneurs bring to an investment opportunity, but that this is an incredibly complex business model, and you have to be prepared to acknowledge that you don't know everything. You know some things well, and that's what's going to compel an investor to give you money as opposed to someone else. And most likely you're also going to be able to articulate what your weaknesses are and how you plan on tackling those weaknesses with outside resources, or bringing in additional folks into the team to help strengthen those potential vulnerabilities. So, you know, we wanted to finish on intangibles because it is so important, particularly for investors, and really wanted to leave you with that point and that reflection before you all sail off and go out and either raise your first round of capital or raise your next round of early stage capital into your respective enterprises. But we do, it looks like, still have a couple of minutes for some final Q&A. So Johanna, I'll pass back to you.
Thanks a lot, Dan. Yeah, we have one question coming in on intangibles. I guess it's a fine balance you have to strike between being humble, as you said, but also being bold. You're trying to sell a business idea in a really difficult market, and you want to convince your investor that you are right and that your business idea is right. So how do we strike that balance between the risk of overselling and being humble at the same time, but not being too humble because you also want to be that bold, powerful entrepreneur that investor is attracted to?
Yeah, that's a great question. And that is a very difficult balance to strike. And I think that ultimately it comes down to the entrepreneurs and the individuals themselves. And I think that, you know, I think one way to sort of strike that balance is to practice. And before you go out and start having, you know, real conversations with real live investors that might part with their money, practice with some friendlies, or even before you go out and start making pitches as a founding team, make a list of what are our particular strengths, what are we really good at, and what are our weaknesses, what keeps us up at night. And in focusing on those weaknesses, say, okay, what is our plan to deal with those weaknesses? How are we going to tackle those? And I think being able to speak to those weaknesses and acknowledge those weaknesses, but also speak to the fact that you have a plan to deal with them, is going to be really compelling for investors. I think what's going to be difficult is, you know, if you're a first-time entrepreneur, you've never worked in the PAYGO solar business, you know, to walk into a conversation with an investor and say, oh, this is easy, I know it all. I guarantee you that investor is going to pick you to pieces on details of the business model that you probably have no idea even exist. So that would be my sort of 2 cents for what it's worth in terms of how to try to strike that balance, but it is very difficult indeed.
Thanks a lot, Dan. Yeah, a lot of self-reflection needed to really do this very well. Reflect with your team, seek feedback also from peers on where your strengths and weaknesses lie as a person to make sure you can mitigate those. Dan, this was the last question coming in. I would very much like to thank you for your wonderful presentation. Thank everyone who attended today's webinar, and remind you that we will put this recording onto our YouTube channel so you can rewatch it. We'll also make the slides available on our Google website for download. And before closing, I would like to thank very much my 2 colleagues, Roran Borst and Juliana Martinez, who very much helped to prepare for this webinar and this academy. and assisted me throughout. Many thanks to Dan and team, and thanks to everyone who dialed in. Have a wonderful rest of the day or wonderful evening.